Thanks, everybody, for tuning in today. We are going to be talking about a very complex subject within the new amendments made to Regulation Z by the Dodd-Frank required provisions. So in terms of our subject matter, we're talking about how to calculate points and fees. This is something that you've probably been doing for a while, but you're going to do it differently. And because the only reason that points and fees mattered in the past was for purposes of determining if you met the trigger for your loan being a high-cost mortgage loans, a lot of you had points and fees that were so far away from tripping that trigger that you really didn't need to do the calculation with any specificity. You just kind of had to know or nowhere close, and you could move on. But now, because the calculation of points and fees also comes into play under certain facets of the ability to repay rule, and because they have changed the way that you calculate points and fees, every bank that makes residential mortgage loans to consumers needs to understand how to perform this calculation. Because they have tweaked the points and fees calculation for purposes of the trigger for high-cost mortgage loans under Section 32, it's believed that some institutions that were formerly not making loans that trip that trigger will find themselves to have some loans that exceed the points and fees amount that causes the loan to become a high-cost mortgage loan. Also, the points and fees at some point are going to need to be reported on the HMDLR, and you've got the fee cap, the points and fees cap, under the ability to repay rules. So we're going to go through step by step to explain, first of all, the context within which the points and fees calculation will need to be done, and then we'll dive into exactly how you do it. As noted on page 2, we have a number of goals here. You need to understand what you include as points and fees, what you can exclude when you use that total of points and fees, and how you're going to manage the points and fees to avoid cap violations under your ability to repay rule and in connection with certain types of qualified mortgages. The entity that is responsible for this part of the rules is the Consumer Financial Protection Bureau. We give you their website address, and this is all stemming from changes made to the Truth in Lending Act, as shown on page 3, by the Dodd-Frank Act and implemented through modifications to some of the provisions in Subpart E of Reg Z. Fortunately, we have official staff commentary in connection with this regulation, and it helps to substantially flesh out what the CFPB means by certain elements of the rule. So turn over to page 4 of the materials. In terms of the overview, again, you really have 3 purposes for which you're looking at points and fees on certain consumer mortgage transactions. One is for purposes of the determination of whether your loan is going to be covered by Section 32 of Reg Z as a high-cost mortgage loan. The second is to get ready for the time when they activate the Dodd-Frank change that says you have to report certain points and fees related information on the HMDLR if you're a HMDA covered financial institution. And then third is for purposes of new fee caps that are part of point 43 of Reg Z, which is the ability to repay qualified mortgage standards portion of the regulation. So let's look first at your high-cost mortgages. You will hear these referred to by any one of several different things. They may be called a high-cost mortgage loan, a Section 32 loan because they're found in 1026.32 of Reg Z, or a HOEPA loan because this part of Reg Z originally came about as a way to implement provisions of the Homeowners Equity Protection Act. So it can be referred to as any of those things. They substantially amended this part of the regulation effective January 10th of 2014. Previously, it only applied to closed-end credit. Now applies to either open-end or closed-end. In either instance, it has to be a loan or an open-end line of credit that would be secured by a consumer's principal dwelling. And since this is within Reg Z, of course, we know that the loan has to be to a natural person, primarily for a personal, family, or household purpose. Once you get past that, you see that there are two main triggers for coverage as a high-cost mortgage loan. The first is one that relates to the APR and the extent to which the APR exceeds the APOR by a certain amount. But what we're focusing on is the second main test, and that is the points and fees test. So there are two definitions of points and fees, or two ways to calculate it, I guess I should say. One is under point 32B1, and that's for closed-end credit, and point 32B2 is for open-end credit. So you want to use the correct one, although, as Jack will explain, they're substantively similar, virtually identical except for two things. And then there's also a prepayment penalty trigger. But today we're focusing on the points and fees trigger. So in the middle of page 4, you see that you calculate the points and fees under the applicable test, B1 or B2, based upon whether it's closed-in or open-in. If the transaction's total points and fees exceed 5% of the total loan amount for a transaction with a loan amount of $20,000 or more, or the lesser of 8% of the total loan amount, or $1,000 for a transaction with a loan amount that's less than $20,000, then it triggers coverage. As with many of the other things that we're going to talk about, the amounts that we just talked about are adjusted annually for inflation. I would recommend that rather than try to keep up with that in your head, that at the first of each year, as these loan amount thresholds are changed, as the lesser of 8% of the total loan amount, or $1,000, as that $1,000 figure changes, that you have a little cheat sheet that you laminate for the personnel within your institution who need to have that information handy. Because as we talk about the points and fees cap under the point 43 of Reg Z, the ability to repay in qualified mortgage standards, you'll see that, again, there are dollar amounts that are going to be adjusted, and you end up with a lot of different numbers that you don't want to have to carry around in your head. You want definitive guidance that you can just look at.